You've been putting money away methodically for decades. You've grown your investment balances. You've achieved real success. And right now you're wondering, what possible reason would I have to hire a professional advisor? I've built everything I have on my own. What could an advisor actually accomplish for me moving ahead? This is exactly the right question to think through, because the truth is this: not everyone requires an advisor, but, and this is critically important, everyone absolutely must understand what's on the line going forward, so that if you're handling things yourself in the years ahead, you're fully aware of the risks and opportunities, because the approach that brought you to where you are right now is not the same approach that will sustain you through the next phase. That's the reason I'm breaking this down for you in this lesson. As someone who holds professional certification in financial planning, I facilitated countless conversations helping individuals make that shift from employment income to drawing from assets. From those interactions, I've witnessed precisely what succeeds, and I've also identified the areas where you don't necessarily require a professional to accomplish the right outcomes. So yes, I'm speaking from the perspective of someone in the advisory profession, but that vantage point has shown me very clearly where professional guidance can create value in ways you might not have considered versus where you're probably perfectly capable of managing things independently without paying for advice. This came up not long ago in a discussion with a potential client. They had approximately $8 million in total wealth, $5 million of which sat in investment vehicles, employer retirement plans, taxable accounts, and so forth. Their question was, "We've never engaged a professional before, and honestly, we've achieved substantial success and we take pride in what we've accomplished independently. So what is it that would now make professional guidance worthwhile to us in the coming years when we've accomplished all this without assistance?" So this lesson is not just about that particular couple I met with. It's about you, and it's about your choice of whether you're going to engage professional help moving forward or handle things yourself. So before I walk through a comprehensive list of the tasks you need to be executing, whether with professional help or without it, in order to make your post-employment years successful, let me address two common misconceptions I encounter repeatedly to make sure we're framing this conversation correctly. Here's the first one. Many people ask, why would I need professional help? I'm not in danger of depleting my savings. I've constructed this substantial portfolio. I don't have any worries about outliving my money. That's wonderful. Many of the people we guide don't have that concern of exhausting their assets during their lifetimes. But just because you're going to survive financially doesn't mean you're executing the optimal strategy to maximize everything you worked to accumulate. In other words, engaging a professional isn't solely about repairing a damaged situation. Engaging a professional is sometimes about taking a strong position that you currently hold and making it even stronger. Now, I'm going to demonstrate specific ways in which that can occur, but I want to clarify that up front. You don't engage a professional merely because you're in a troubled position. The second misconception is this. People say, well, you can't generate superior market returns, so why would you pay for professional guidance? Here's the reality. I completely agree with you. If you're attempting to actively select individual securities to generate superior returns, the odds are extremely high that you're going to underperform over extended periods. It is exceptionally difficult to surpass a benchmark index, such as a broad equity index. The misconception people carry is they think if I'm going to pay for professional guidance, the reason I'm doing that is so they can select superior holdings compared to the index. Here's the truth. There's an extremely low probability of that happening. And if that's what you believe you're paying for, you shouldn't. They're not going to be able to consistently deliver that. That is not the reason you should pay for professional guidance. So I'm clarifying those two misconceptions at the outset, because so many of the individuals I've spoken with believe those two things, that they're already in a strong position without professional help, and that a professional can't surpass index performance. They think those are the criteria they should evaluate in deciding whether to engage professional help, but those aren't the functions that a professional should be delivering for you. So now what I want to focus on is what are the tasks that you should execute by yourself without professional help, or you should absolutely be collaborating with a professional to help with, because these are the functions that actually create value that are going to make your post-employment years a more fulfilling experience. The first thing you want to grasp is your investment structure. What brought you to this point will not carry you through the next phase. In other words, what you executed to grow your wealth, that may have functioned tremendously well. And even if it did, I'm going to tell you that's not the optimal approach you should use when you begin drawing from your wealth to have that money support you throughout your non-working years. The reasons for this are straightforward. If you're 45 and the market declines 40%, that's a fantastic opportunity to add to your positions. If you're 65 and the market declines 40%, while you're simultaneously withdrawing 4 to 5% annually, that's a potentially catastrophic experience for your financial security. So during your accumulation phase, the primary concern is what's the average return of the various holdings you own in your employer plans, in your taxable accounts. In the distribution phase, average return becomes irrelevant. Your sequence of return becomes critical, the manner in which you extract money from your holdings. So it's much more about constructing the appropriate type of structure, not to achieve an average return, but to provide you flexibility and to provide you the optionality of where you can extract funds from, whether the market's rising, falling, or moving sideways without having to worry about sequence of return risk. So as you're nearing the transition to drawing from assets, do you have an investment structure that's designed to support that? That investment structure needs to incorporate the precisely calibrated mix of conservative, stable holdings to protect you against market declines with the appropriate mix of growth assets to keep pace with inflation and increase your purchase power over time. That's not some arbitrary allocation formula. It's a specifically calibrated structure that's unique to your objectives, and more specifically unique to your cash requirements. In the distribution phase, your income streams and your obligations are going to fluctuate. Maybe you stop working and government retirement benefits haven't started yet. Or maybe you stop working and your employer pension hasn't commenced yet. Or maybe you've transitioned and you have a mortgage for the initial years of this phase, but that obligation disappears down the road. What you can begin to see here in this example is the amount you need to extract from your holdings is going to fluctuate over time. It's not as straightforward as saying you're just going to extract 4% annually and maintain that forever. Your amount that comes from your portfolio needs to be reflected in how you structure your holdings. So your distribution phase portfolio needs to make that strategic shift from what brought you here in your accumulation years to what's going to deliver the cash flow you need to maintain your lifestyle, while also protecting against sequence of return risk in this new phase. So that's the first function you need to execute. Make sure your investment structure is properly calibrated. The second area where a professional might be able to create value is in the tax planning component of your strategy. I will say this is the single most significant area where a skilled professional can add measurable value to someone in their post-employment years. The reason I emphasize that is because too often people who manage their own distribution strategy, they simply extract money from their holdings in a proportionate manner, or they don't comprehend the impact of required minimum distributions in the future. And so they feel comfortable in the initial years because they're maintaining their tax bracket low. But as soon as required minimum distributions begin, those distributions are layered on top of government retirement benefits, on top of their other dividends and income, on top of all that, and it creates this tax situation that they can no longer circumvent, so they're forced into a substantially higher tax bracket in their later years, which depletes their holdings when they could have implemented a strategy to reduce their taxes over the course of this phase. So what does tax planning in the distribution phase look like? Well, it looks like conversion strategies to tax-advantaged accounts. It looks like asset location, So not just what holdings do you own, but what accounts are those holdings held in? It looks like tax bracket management. So do you understand your federal ordinary income tax bracket? Do you know what your federal capital gains tax bracket is? Do you know your state income tax bracket? Do you know what income-related monthly adjustment amount surcharge tier you're at? Do you understand provisional income and what amount of your government retirement benefits are going to be taxed? And not only do you know that right now, but do you have a projection of how it's going to change over the course of your remaining years? Because it's not sufficient to have a snapshot of where you are right now. In order to implement a strategy, you need to compare today to where you're projected to be in the future, so you understand when to realize certain types of gains and when to implement certain tax planning techniques. If you are executing that and you find satisfaction in doing that, excellent. You might not need a professional. But if you're not executing that, or you don't really find satisfaction in doing that, that is an area where a skilled professional can quite literally preserve hundreds of thousands of dollars, if not more, in taxes over the course of this phase. Now, none of this is guaranteed because I don't know your particular circumstances. All I'm speaking about is based upon the circumstances and people we've collaborated with, and being able to measure tax savings that are going to benefit them tremendously over the course of their post-employment years. The third thing you need to understand when evaluating whether I need a professional or whether I handle this myself is you need to understand the invisible costs. Yes, you observe the cost of the advisory fee. That advisory fee might be $10,000, $30,000, $50,000, depending on the size of your holdings. That is very obvious, very tangible, very confronting, but do not dismiss the fees and the cost you don't observe, because I'll tell you this, there is no option that doesn't carry any cost. It's not fee or no fee, it's this cost or that cost. The challenge is the advisory cost is very obvious and you observe it. The cost of not doing that is potentially invisible. Let's quickly examine a few examples where that manifests. The cost of the performance you don't capture over time. Now, I'm not talking about performance of a professional should be able to surpass the broad index in your large cap growth allocation. What I'm talking about is a properly constructed portfolio that's managing against the risks that this phase inherently presents while also optimizing your growth potential over time. What's the cost of underperforming that? You'll never know. You'll never observe it. It's just going to manifest as reduced growth over time. What's the cost of the money you don't utilize? Now, this is one of the paradoxical aspects about collaborating with a skilled professional. A skilled professional is going to help you and encourage you to utilize more money. Too often, the people we guide come to us. They spent their entire careers working and grinding and accumulating, and they have this substantial portfolio, but fear prevents them from fully being able to enjoy it, fully being able to utilize it. And more times than not, that means they're going to finish with far more money in their holdings at the end of their lifetimes than they ever possessed at any point in their life before that. Is that really your objective? Is your objective really to pass away with 3 times as much money in your portfolio at the end of this phase than you had entering this phase? You might think that sounds absurd, but that's a very common reality for many individuals I speak with. And it's not because they have intentions of leaving some substantial inheritance for their children or their family. It's because of fear. That fear prevents them from utilizing their wealth. And what seems like maybe not the worst outcome, I'm going to reframe that for you differently. What that actually means is you're going to wake up one day with a tremendous amount of regret about what could you have done with that money. What trips could you have taken with your family before your spouse passed away, before your friends passed away? What things could you have experienced before your health started to decline? What are the causes that you could have supported when they most needed it? So the cost of not utilizing money sounds like something that's perhaps not too concerning. Don't worry too much about it. But the reality is that's going to manifest as regret. And if there's one thing you can accomplish over the course of your life, over the course of this phase, is execute the things today that will minimize your regret 20 years from now. So the money you don't utilize can be a tremendous cost of not executing things the optimal way in your post-employment years. Another cost is what's the cost of your time? What's the cost of your energy? Maybe you are genuinely excellent at this, but do you genuinely want to transition from work and have another full commitment? Do you genuinely want to transition and know that everything is on you? This thing that you've constructed over the course of your lifetime, your ability to stop working, your ability to support your family, to execute the things you want to execute, all of that is on you. So even if you're skilled at it, do you want to transition from work just to return to work again, to make certain that you're overseeing this, to make certain that you're managing this? If so, excellent. If you find satisfaction in this, excellent. I've encountered many individuals that are both very skilled at this and genuinely find satisfaction doing this. Now, assuming you have a contingency plan in place, if you pass away and your spouse assumes responsibility, continue doing it. But for those of you that don't want your time to be spent evaluating your holdings or your cash flow, your tax planning, that's where a skilled professional could come into the picture. Now, I just mentioned this, but the next thing you need to consider is surviving spouse protection. Maybe you're genuinely skilled at this, and I don't mean protection in the literal sense of acquiring a policy, but what would occur if you were to pass away today? Does your spouse know where to access your brokerage accounts? Does your spouse know when to claim government retirement benefits and where to extract the next amount of their cash flow from? Does your spouse have the ability to file taxes and to be able to incorporate your conversion strategy to tax-advantaged accounts accurately into that? If not, you either need to make certain they are prepared for that you've trained them, or that you've demonstrated to them what needs to occur, or that there's a contingency plan in place, that there's a partner that could help your spouse if that were to be the scenario, so that you passing away isn't just an emotional burden, but it also becomes an extreme financial burden. This is where a skilled professional can be that continuity plan that you can trust to look out for your spouse if you were to pass away first. The next area where a professional can create value is being those behavioral safeguards. We all like to believe we're perfectly rational with everything we execute. But I can tell you perhaps the single most significant thing that makes otherwise rational individuals make incredibly emotional choices is their money. Because your money isn't just a portfolio. Your money is your livelihood. Your money represents future security. Your money represents your ability to actually live the life you want to live in this phase. So given that, it's completely normal that we would be incredibly emotional about this. Now, when I say emotional, I don't mean that in a negative sense. I mean this in you have a deeply vested interest in this functioning well, and with that comes a profound fear of things going wrong. So how does that manifest? It manifests in one of two ways. One is utilization. I already mentioned that it's going to be very challenging for those of you who have constructed a substantial portfolio to just reverse course and start drawing from that portfolio in this new phase. The cost of not utilizing your portfolio is your portfolio continues growing. Sounds like a favorable thing on paper, but in reality that leads to a tremendous amount of regret because you missed out on all that life could have offered had you had the permission to utilize your wealth. And many times that permission comes from having a strategy that a professional helps to walk you through. The second aspect is when markets become turbulent. Now, nobody believes, yourself included, that they're going to be the ones to make an emotion-driven choice in the midst of a market decline. You may even be saying, I've been investing for 40 years, I've never once been concerned, I've never once made a modification when markets declined. That is accurate, but it's going to be a very different experience when you transition. And now, all of a sudden, a market decline isn't an opportunity that you're contributing money into. A market decline is something that you still have to extract money from. That's going to become a very difficult thing. Now you combine that with the headlines circulating, and I've witnessed very rational individuals make very emotion-driven choices with their holdings, even just in the recent past. Everything from tariff announcements to market corrections to significant sell-offs in particular sectors to major economic events to political transitions. You name it. Whatever your political views, whatever your worldview is, there have been abundant reasons as an investor to be completely terrified about remaining invested over just the recent years. Here's the thing. That's 5-6 years of sample size. You extend that to 80, 90, 100 years, there's always something that feels like this time is different. This time things are not going to be able to recover. Now, when you're in the midst of attempting to preserve this thing that you've constructed, you're in the midst of attempting to protect yourself and your spouse and your family to ensure your holdings last. You combine that with markets dropping rapidly 20, 30, 40%. It is not uncommon at all for individuals to make one single mistake in the midst of a 20 to 30-year retirement phase, and the cost of that mistake significantly exceeds the cumulative cost of a professional over the course of that full 20 to 30-year phase. So those behavioral aspects, we all have blind spots, and by the very definition of a blind spot, we don't observe it. You have blind spots, I have blind spots. Sometimes collaborating with a professional is an excellent opportunity for someone else to illuminate those blind spots in our lives, so we know what to look out for. We don't make the choices that end up costing us far more than the cost of a professional ever would. So as I return to what I mentioned before, there is a very obvious cost of collaborating with a professional, especially if you've never engaged one before. The sticker shock of what that can be substantial, but don't let that mislead you into thinking that maintaining your current approach is without cost. There are so many invisible costs that aren't as obvious. They're not going to be itemized on a statement for you, but they absolutely exist. And if you're going to be your own professional throughout this phase, you need to be mindful of these, and you need to be very aware. That one single mistake there could significantly exceed the cost of collaborating with a professional. So as I listed everything I just walked through, if you hear that and you're confident you can execute that, if you find satisfaction doing that, and if, assuming you're married, your spouse could continue executing that even if you passed away first, why engage a professional? Why spend the money to do that? But if that's not the scenario, then my final question to you is this. How much money would you invest to have reduced stress, reduced anxiety, increased peace of mind, and in fact probably a superior financial outcome than if you didn't invest that money? That is how I would frame the value of a skilled professional advisor. None of this is guaranteed. There's nothing here that you can guarantee in advance. You provide an input and receive an output the other side. But when you're collaborating with a skilled professional, that should be what you're receiving. You're receiving clarity. You're receiving simplicity. You're receiving peace of mind. And incidentally, a skilled professional should be able to create measurable value that exceeds the cost of what you're paying them. So as we conclude, recognize that yes, there is a cost of collaborating with a professional, but there's also a cost of not collaborating with one. The stakes are too high for you to simply continue executing what's functioned up until this point, assuming it's going to function moving forward without understanding what might need to change.